It's up to you, whatever you're comfortable with. I think somebody will have to allow me to share my screen. Achha, I have that permission.
Yes, you have Anuj. Shall we start, sir?
Yeah, please. I think start.
Yeah, can you give me 2 minutes before I can just sort of share my screen?
What Harshit will be doing is just giving a brief introduction before handing over to you. So just giving a little bit about MIT Innovation Incubator also. Okay.
So good afternoon, everyone. I, Harshit Agarwal, representing MIT Innovation Incubator, Gurugram. For today's session, we welcome you all. Topic for today's session is how a startup can design a sustainable business model. Before starting today's session, I want to shed some light on MIT Innovation Incubator Gurugram. MIT Innovation Incubator Gurugram at MIT University, Haryana, is supported by Ministry of Electronics and Information Technology under TIDE Scheme 2.0. We are supported by DST, Atal Innovation Mission Niti Aayog, MSME. We have started our operation way back in 2007 at our headquarters in Noida, with physical presence of in 7 states and 17 virtual locations and 7 locations abroad. We have assisted more than 500 ventures and have invested in 55 ventures through MIT Capital Venture, which is our investment vehicle. So for more details, you can reach out to us at info@aii.mit.edu. What we'll do is we'll write this email address in the chat box. Now, coming back to today's session, we have Mr. Anuj Bali, founder and CEO of Unbeck Advisors, to share his experience on sustainable business model. Anuj is a CA and having more than 10 years of experience in international tech structuring, fundraising, mentorship, legal advisory, audit, and bookkeeping. On the behalf of MIT Innovation Incubator, I express my gratitude to you, Anuj, and thank you so much for accepting our invitation and giving us your time. So over to you. If we are ready with the presentation, Anuj.
Sure. Okay. Thank you so much for the intro, Harshit. It's our pleasure to share our knowledge and experience with everyone. We see the startup sector in India booming right from 2012 onwards. And, those were the days when, people used to talk about going to the Silicon Valley to get the next round of funding, but that's not the case anymore. People talk about their IPO in India, and, they've got all the support from all the fund houses till Series G. And so that's a great shift that we've seen over the years. And we are here to share all our knowledge and experience with the entire startup community. Thanks for taking this initiative, Harshit. Shall we start now?
Yeah, sure. We are ready.
So, as you know, we've already been introduced by Harshit. We are Unbeck Advisors. We are a financial and legal consulting firm. We have advised more than 1,500 startups in India, Singapore, and US region over the past eight and a half years now. And we've seen startups booming and growing at an abnormally fast rate and then shutting down, right? So that brings us to the main question as to how important is sustainability for the business. So mad growth versus sustainable business. So today we're going to cover certain strategies that a lot of startups can adopt, and what are the learnings that we can take from various startups that we've seen over the past 10 years, how they've fared, what they've done right, what they've done wrong, and these things. Yeah. So these things will help us to understand how we can take these learnings and incorporate these into our startup and turn it into a sustainable business for us. So there's a very interesting quote, and this is referred to quite a lot of times. where everyone knows, and most of the startups, which is 90% or more, I would say that this might be changing every year, might be going to 95%, 98%, sometimes going to 92%, but at least on an average 90% of the startups do fail over the first 3 to 5 years. And I would say that 80% would fall in the first 3 years category, where they fail in the initial years of operation. So what is the reason, right? And you know sometimes it is good to know what to do to be successful, but the more important thing to know is what not to do. And what we are going to today focus on, what these 90% of the startups do that turns them into a failure. If you don't do these things, you will end up doing the right things, right? So let's look at the reasons. So we analyzed the reports that have come up, studying the startup industry over the past 10 years or so, and even based on our experience, we quite agree with these reasons. So financial indiscipline turned out to be one of the top reasons why they fail. Right. So financial indiscipline in the sense that a lot of these startups do know how much money they want to raise, but they do not know what do they want to do with that money, right? And how would they utilize that money to end up into a situation where the business will be able to generate a profit for them over the next few years. That is the first reason why, due to a financial indiscipline, most of the startups fail, because they a lot of startups have timelines as to when do they want to raise the next round, but they do not have a ready plan to say that this is the year that I'm going to get profitable in. This is primarily the reason why they are not able to become what our prime minister is wanting everybody to become, which is Atmanirbhar. So a lot of startups are not able to be Atmanirbhar or financially nirbhar on themselves. And as you see, we have a few examples here, ranging from Pepper Tap to Stazilla. All of these are victims of financial indiscipline. Business model failure. This turns out to be the second biggest reason why startups fail, which is that they are either too early into the business, or their entire business model will not result in a profit over the long term. And this is something that they realize when they start being in that business, and they realize that even after a particular scale they'll not be able to achieve profits, which is why a lot of businesses, a lot of industries are not, uh, from a business model perspective, they don't have the inherent uh, uh, potential to be sustainable or to sustain a certain amount of profit. So that is another reason, that most of the startups fail. There's lack of relevant industry experience. This has been observed not just in these reports, but even from our personal experience. What we've realized is that when startups do have an idea, they tend to start working on it. But where they tend to fail is not having enough relevant industry experience, right? If I am not belonging to the food industry and I don't know the dynamics of the food industry, I will end up wasting about 2 to 3 years of my life only to understand how the industry works. So one of the most important things that startup founders miss out on is that they do not start something that they're good at. They start at something that they think is looking greener. So grass on the other side is always greener. So you have this thing that a banker would say that I'm more interested in the food industry. The food industry guy will say I'm more interested in the real estate. The real estate guy will say that these stock market experts are making more money. So they tend to keep shifting businesses or starting something which is not their domain expertise, which is why they don't understand the trade secrets, and they are not able to compete in the market. So if you're entering into a business and you are thinking of taking on certain giants who are already established in that particular industry, and you're wanting to uh, you know have a huge impact. You can't do it unless you have extremely good understanding of the industry. And if you're not from that industry, it takes you about 2 to 3 years at least to understand the nitty-gritties of that industry, which is why, I have seen, even at our firm, we see a lot of our clients who are not able to go beyond 4 years, primarily because 2 to 3 years of their time is invested only to understand that particular industry, and which is not a great idea. Which is why you'll see a lot of startups having a lot of mentors on board, because they want to understand the industry, because they're not from that industry. So that's another thing. Misfit product lines, this is another huge uh, you know thing that you need to understand. A lot of startups come up with product lines which are not really fit at that particular point of time. You might be early or you might be late to enter that particular industry. So Stayzilla was a homestays business, but they were, they would, I would say, they would fall into the financial indiscipline as well as the misfit product lines category. What they started or what they wanted to achieve was, a little too early for them. So which is why, they ended up failing even after raising more than $38 million, which is a huge amount of money for you to at least turn into a sustainable business. So there was not even a business that was built. Very ineffective marketing and network strategies. Of course, there are people who are good product guys. We have in India, you have one of the best tech brains. You have good product guys, but at times they're not able to take that out into the market, which results in the failure of business. So, creating the right product at the right time and seeing that there is potential to make profit on a transactional level, and then, marketing it and taking it to the masses is the last challenge, due to which a lot of startups end up failing. So, yeah, can we move to the next slide, please? So we wanted to give you a brief of, how the businesses have evolved over the past few years, right from 1970s, where India was not as rich. I would not say that India is extremely rich today, but of course, compared to 1970s, we are a much wealthier state today. And in the 1970s, we had family businesses like Tata's and the Birla groups that raised money primarily from friends and family. And, bootstrapping was not really a word, but that was the only norm in business at that point of time. And, they've built hugely sustainable businesses, of course, that need not be mentioned. Then we saw the uh, next decade of Reliance and the likes, where the money was primarily raised from the public, and public money was accessed. So moving from friends and family to public money, that was the next phase that we entered in. Then we saw the IT revolution in the 90s, where friends and families, a little bit of fund houses, and public at large got interested into investing. And that's when the Sensex and the NSE and the SEBI also came into being, and we saw that kind of a revolution coming in. And now, since 2010 onwards, so we see a lot of these changes on a decade basis. You will not really see changes in 1 to 2 years, but if you analyze a decade, you'll understand how businesses have changed. And then we see the likes of Paytm, Snapdeal, Flipkart, Mintra, and all of these fund houses, which all of these great startups who are backed by private fund houses. uh, so now today's question is, should we be going back to the 1970s? Should we be looking at the 90s? Should we be looking at the era of the Reliance, or should we be looking at the era of the Paytms and the Snapdeals and the Flipkarts. So we will share our view on the two types of approaches that we have. Can we move to the next slide, please? So the two distinct models that have emerged out, and these are the only two models that are going to be seen over the next decade. So we've seen the past 40 to 50 years, the past 3 to 4 decades, and what does the next 2 decades hold is the real question. And if you as an entrepreneur are able to have the vision and the forecast to see what's going to be the next big thing and how the global businesses are going to function, you will turn out to be a winner, and you'll be able to create a sustainable business. So there is a non-revenue model which I feel is yeah, extremely popular because of the great numbers that we see in terms of the exits that we see. If you look at Instagram, if you look at WhatsApp, these two companies did not even have revenues when they ended up into an exit with Facebook. So, so so this is one model where you don't focus on the revenues, you just focus on creating value, and somebody comes in, takes it over, and turns it into a profitable business in just a year or two. So monetization is not really the focus in these kind of businesses. A lot of people do tend to criticize models which are in losses. Recently Zomato being thrashed for the IPO that it had come up with. And a lot of people criticize, saying that it's a loss making entity, and having a valuation of that level does not make sense. But what we have to understand is that this is something that is very, very new for the stock markets. There's something which is very new for the business community as a whole to accept that there is this company, there is this is a brand which is created and which is in tremendous amount of loss, and yet people tend to value it at such a high price. Is something wrong with the people who are valuing it, or is this some sort of a Ponzi scheme sort of a thing that people are saying that they will just keep on increasing the valuation and take out their money and walk away? That's not the case. People are not able to see how businesses are changing over the next 1 or 2 decades now, going from here. So these are fast growth models. These are backed by immense amount of capital, and their competitive advantage tends to be not their idea or their unique skill set, but the amount of capital that they are backed with. So if you want to today start a Zomato, you'll not be able to compete with a Zomato, purely because the amount of money that Zomato has as a backing will not let you survive in that market, and the amount of geographical presence that Zomato would have with that kind of a money, you'll not be able to compete with. So this is typically in India how we see that Reliance with that kind of money is not able to let any of its competitors prevail in the market, primarily because the amount of money that they can put in and the amount of losses that they can bear for a great amount of time. So this is one way that this is the new style of business, which I would say is artistic business, where you just create great value and you have great money backing you, and so money becomes your biggest competitive advantage. Talking about sustainability, these businesses are not really sustainable because they are to be backed by a lot of money till a huge amount of scale is achieved. Amazon is a huge example for everybody who thinks that these will never become sustainable. They do tend to become sustainable, but after a huge amount of time. Like Amazon took about 20 years, or even in fact more than that. Talking about sustainable profit models, we can look at great examples like Wow Momos, Urban Ladder, Wakefit. So these are, models where you have no amount of funding or a very reasonable amount of funding that has gone into it, and they have built on sustainability, profitability, which is why you'll not see great growth here, but definitely a sustained growth, because even if they are not funded for about 2 years, their operations are not going to go on a halt. They are reasonably well funded, and these kind of businesses tend to take advantage of both eras, where bootstrapping and running a profitable business is considered to be the basic norm, while they also tend to take funding for growth. So this is a much more stable model if you don't have extremely heavy on the pockets fund houses backing you. B2B businesses primarily can really function in the sustainable profit model. But seeing the success of Wow Momos and Urban Ladders and the likes of Wakefit, they've all proved that even a B2C can be run profitably and need not have a huge amount of scale to turn into a profitable business, which is a story being told to in the business community for so long now. Can we move to the next slide, please? So talking about sustainable business, if you were to ask yourself as to how you need to create a sustainable business model, sustainability in a business will primarily come from two macro factors. One is your need for that particular product at that point of time. So your product timing has to be extremely right. If there is no demand for that particular product at that pricing level, the sustainability from an operational standpoint, from a business model perspective, is ruled out. So that is the first thing. So considering that the founders have immense industry knowledge and expertise, we have not touched upon that point. We have touched upon the financial parameters that you need to keep in check in order to run a sustainable business model. Then the first question that must be answered by a founder is that, is whatever he's selling, even if say he's an if you run an aggregator model, whether you run any particular model, so to say, you have to be profitable at a transactional level. So what do we mean by transactional profit? Transactional profit, which is also referred to as the gross profit in our financial terminology, is that every transaction should result in a gain for you. So if this basic parameter is not met, then your sustainability is hugely questionable, right? If I'm selling furniture online, and I'm an aggregator, and I'm selling a chair for 10,000 INR, while I'm obtaining it from the vendors at 12,000. So my transactional profit, which is the buying and the selling of that particular chair, if that itself is not profitable, then your sustainability is hugely questionable, and you'll not be able to survive in the long run. That's for sure. A lot of people tend to give this funda that this 2,000 that I'm losing out is the customer acquisition, or the retention cost that is going into the user acquisition or the retention. But that is not a very sustainable model. And once you become a huge brand, then your returns on orders, all of those costs that add up, the logistics and everything, that will never let you turn into profit, which is what happens with a lot of startups at scale. We tend to use the services of these great startups, but we tend to see a huge loss on their balance sheets, which is primarily because they're not able to meet a transactional profit in the first place. We talk about salaries, corporate office, marketing expenses, but if you're not profitable at the transactional level, then that business and its sustainability is hugely questionable. The second is the break-even analysis. Where, so to put it very simply, you need to know that for your particular business, and if it's a B2C business primarily, even for a B2B business, this should be done. And this is a fairly simpler task for a B2B compared to a B2C. But for a B2C as well, a lot of businesses cannot turn profitable unless a particular amount of customers are reached. So if you don't reach a particular volume of customers, you'll not be able to turn into profit. So this break-even analysis, which is that at what customer level do I reach a no profit, no loss situation, is an analysis that must be done by the founder. And you cannot do your budgeting, you cannot do budget allocations for marketing and other things if you don't have a break-even analysis to say that at this particular customer level, I'll turn into profits. The third is the importance of financial modeling and analysis, which we recommend to every startups. We prepare financial models for startups to know where do they stand as on date, and the founder should always be in control of their finances in terms of their budgets. When do they run out of money? When do they need to reduce their spends? When do they need to accelerate the spends? If you don't have those things in place, your decision taking from a financial perspective will always be flawed. So it is very, very important to have a financial model and internal analysis for the founders to be in place. And then, of course, you should seek professional guidance. You should, people who are, experts in their particular field should always be consulted. So that's what we do. And we are able to quite easily, more than 95% of the times, we are able to predict whether a particular business will be able to sustain for a period of 1 year or more or no. And that's because we are able to assess from a financial perspective that the financials and the financial indiscipline will lead to eventual failure of that startup. Can we move to the next slide, please? Another very, very important qualitative factor. This is not really a quantitative factor, but a very qualitative factor that has been observed is the co-founding team's stability. So, one of the Harvard professors rightly pointed out that 65% of the high potential startups fail due to conflict among the co-founders. So, conflict among the co-founders is a huge reason why a lot of startups fall apart. There are two co-founders usually who start a particular business with a particular vision, and if one of them tends to walk away, the other tends to become either demotivated or not having enough confidence to carry on. And sometimes it is also about the fact that sometimes these splits happen after a period of 2 to 3 years, while the company has already reached a particular stage, and one of the founders is wanting to continue while the other does not want to continue. So these things are extremely important. You should have co-founders agreement that has exit clauses for the co-founders. If one of them wants to walk out, what should be his fair share to be given? How should his exit be planned? What should be the roles and responsibilities of each co-founder? If there is a new co-founder to come in and replace the outgoing co-founder, what is going to be the clauses for that, the salary distribution, the dispute resolution, the dilution clause. All of these things are extremely important to keep a company stable, because when you start off a company, you're not thinking about stability, you're just thinking about building it. But by the time you end up building it, you realize that falling apart of the co-founders tends to put a stop to the business. So sustainability becomes a huge challenge when the co-founding team itself is not stable. We've all, I'm sure, must have read the story of Mark Zuckerberg. How he came out of that mess, and he had to compensate a lot of the founding member teams or people who had claimed that it was their idea, and we have many more such examples. So co-founding team stability is extremely important. aspect, that we consider from a sustainability standpoint. And we have also seen a lot of startups, a lot of our clients falling apart or entering into an extreme amount of restructuring, primarily because the co-founding team is not able to take it forward after a particular point of time. Can we move to the next, please? So what are the key strategies that you can adopt or learn from various businesses to build a sustainable business? So as we've pointed out that there are qualitative and quantitative factors, so we've tried to put all of those here, and learning from successful and failed startups both, to know what we can learn from them. Geo, as we all know, that product pricing is extremely important. For you to have a sustainable business, your product pricing has to be such that it does not pinch the pockets of your target group. Geo being a service which is for the masses, their pricing had to be lower, which is why they were able to sustain, and they were able to put that pricing and have Geo sustain. But for a company like Mercedes or a BMW, probably that product pricing will have to be a little higher, but at the same time it has to be in a range that your customers are willing to pay. This particular analysis is extremely important. And this has to be also in line with the transactional profit relationship, which we've learned from Zerotha, that they've always, they've also had very low margins, but from a transactional profit standpoint, they've always remained transactionally profitable, which means that every customer that invests through Zerotha will give them a profit at a transactional level. Their acquisition cost, for acquiring that particular customer, vis-a-vis the amount of business or the amount of revenue that the customer will give, should be profitable. So product pricing and your spend on acquiring that customer, that has to be extremely aligned to run a profitable business. Market timing, Webvan, this is a case study. They were too early into the business, and they entered the market in 2010, which was extremely early, for the market. I think 2001. I'm sorry. They entered the market in 2001, which was so early for an online grocery related business, that it ended up into a failure, because your market timing is extremely important. It's good to be a visionary, but sometimes when you are too ahead of the market, you end up burning a lot of cash and you're not getting success. So one of the great examples that I can think of from our India market perspective, Urban Clap. So Urban Clap was one model that was tried out by a lot of players, but the right timing of Urban Clap, when people had started trusting the online market, and they had started accepting the marketplace model, that's when Urban Clap hit the market, and that's the primary reason for the success of Urban Clap, according to me, because what they've done is something that could have been done by many others. And we still have a lot of local players who are providing this kind of a service, but never has any player been able to become as big as Urban Clap, primarily because they got right access to capital, plus the extremely right amount of timing that they had at that point of time. Boat, so what we can learn from Boat is the internal budget estimate. So regular internal budget estimates is extremely important, so that you know where you stand at any particular point of time. What is the amount of money that you should put into the marketing of the brand. What is the amount of budget that you can put for the growth. So budget estimates is extremely important. Boat is another great model. The founders also often say that we are the Zaras of the electronics, audio device industry, where we want to offer luxury products but at a lower price, and yet not give cheap products like a Chinese made sort of a product. So that's again their pricing as well as their internal budget estimates has kept them profitable, because they've not gone too overboard on spending on marketing and other activities. And that's been a great thing for them, which has turned them into a sustainable business. Economic moat. So this primarily points to your competitor analysis and the competitive advantage that you have as a business. So a lot of businesses are not able to sustain only because more competitors come in, reduce the pricing, and make it very, very difficult for you to survive at that particular price range. And when you start reducing that price range, your economics don't match up and you're not able to be profitable. So what we learned from Starbucks is that at the end of the day, what they're ultimately selling is coffee, right? And selling coffee is, I don't think, is an extremely is not a product which is not differentiable. Is something that any say cafe coffee day or any other competitors would have been able to do. Just a moment. I think we are not able to see the screen share. Can just share? Can you share the screen? Okay. Anyways, so we were talking about Starbucks and its economic moat, which is that Starbucks is, the end of the day, is just selling coffee, right? But the amount of money that they put in and the amount of strategy that they put it into the brand building of Starbucks and the innovation in the drinks that they came out with has given them such a competitive advantage just in the coffee space, that a product which is not at all differentiable has become differentiable. And this is an extremely good amount of learning that you can take from Starbucks. Another great example for this is Coca-Cola. Coca-Cola and Pepsi were not very different, but their marketing strategies and the way that they have sort of played out with the brains of their potential customers, to make it more appealing, uh, is an extreme amount of learning that you can do. This is primarily when you reach a particular scale, this, and you have a lot of competitors, this becomes the extremely important part to keep you sustained. Which is why a lot of these in these times we see heavily uh, backed by capital startups like Zomatos and the Swiggies of the world, because economic mode becomes a huge challenge, because after a point of time your competitors are going to come in, reduce the pricing, and going to go for the kill. But these kind of startups sustain on losses for a huge amount of time, till the time that no other competitor is able to give them that advantage. But if you're running a sustainable business, your idols will not have to be the Zomatos and the Amazons of the world who got access to huge amount of capital. But I would say Starbucks, Coca-Cola, and these companies that have used their profits, limited amount of capital, to keep them going. Then of course having control over your IP is extremely important. Airbnb also has a lot of competitors, but you don't tend to learn too much about the names of any competitors of Airbnb, whether it's homestays and so many other brands. But the if you want to have a homestay while you're traveling, then Airbnb tends to be your go-to app. So these are the key strategies that you must adopt. Your chances of falling into the 10% category, the startups that do not fail, goes extremely high if you stick to these particular fundas. Can we move on to the next slide, please? We've collated a few case studies for you, right? What we've spoken about, though we have taken examples, live examples of startups in India and outside India, but I think these are some great startups in today's generation that we see in the last decade, that have grown really quick, fast, and have had a sustainable business. Our ladder, everyone must be aware that Reliance acquired it for a 182 crore valuation, and while a lot of its competitors tend to boast of higher numbers in terms of revenues, but Urban Ladder has stuck to excelling in one particular area, which is that they will provide a good furniture, right, at the best price range, and they've stuck to the funda of being profitable, uh, which has led to their success. And you don't see too much of advertisement spend on by Urban Ladder, primarily because they're profitable. While any company that is not financially disciplined will tend to spend more money into marketing and acquiring more customers and ending up into a non-sustainable zone, which we should learn from Urban Ladder here. Zerodha is another great example. This was started in 2010. We didn't hear much about Zerodha, though a lot of its success also came in the past 2 years when there was this COVID situation when everyone was stuck at home and looking at options to invest, and that's when Zerodha really took off. And so the best part is that apart from an initial amount of minor money that they put in, there has never been any sort of fundraise done by them from any private fund houses, P funds, and still they've run an extremely profitable business, which stands at 1,000 crore today. And what they targeted was the brokerage that always pinched the investors when they had to buy stocks and mutual funds, and the great amount of potential that they've capitalized on is extremely important for all the startups to learn that there was a huge market that they thought that did not invest into stocks, and they were looking at that young population of India that was in the less than 10 years of work experience, and they would like to try out investing into stocks. And that was a huge potential, right? They didn't have a demat account with which they were already transacting. They had to look for the first demat account or the first stockbroker to go to. And Zerodha, because of its extremely good amount of timing and pricing, turned out to be great success. And of course, COVID gave them a great push. So this is something we must learn from Zerodha. Can you move on to the next slides, please? Zoho, I'm sure maybe a few of our viewers here might be using Zoho. Zoho, is again, they had the same strategy like Zara or Boat, where they did not target customers who are wanting to pay a premium, an extreme amount of premium for this for the usage of the CRM softwares. Rather, they would look at low cost, but not extremely low, but still I would say quite affordable. And that's been their great success model. Their highly user friendly client relationship management system, they boast of this, but I feel that along with the great product quality that they gave, the right pricing turned out to be Zoho's success model. And today, with the startup community boosting so well. Zoho turns out to be a great winner here because a lot of startups will not tend to go for a Salesforce or a similar sort of a software, but they would easily be ready to experiment with the Zoho. And once that's what happens with software, right? Once you experiment, you tend to stick to it. And Zoho always knew about this, and when it knew that for the Indian market, the price is an extremely sensitive area, and people would want to try out if your pricing is good enough for them to try it out. And once you try it out, you tend to get comfortable, and that's what so capitalized on. And extremely good strategy, I would say, of keeping the pricing point in such a manner that your transactionally you are at a profitable stage. At every transaction you are at profit. At the same time, your pricing is extremely right for people to try it out. Another great example that we have is Nika. Nika has been profitable with a revenue of approximately 2,000 crores now. They're planning an IPO in 2022. What did Nika do right? It's extremely important to understand. While a lot of startups have been selling the story of a marketplace where they don't have control over the inventory, they don't want to get into the operation management part of it. Nika came up with the inventory led business model where they said that we are going to take ownership of the inventory, we are going to control the product quality, we are going to be hands on the product. While most of the startups at the same time were giving a disclaimer saying that it's not our responsibility, we're just connecting the buyer and the seller. While Nika came out and said that I am going to take full control over the quality that is being delivered. What did this bring to Nika? It resulted in lesser amount of returns and repeat customers, and that 20% margin which the Flipkarts and the Mintras of the world lose out on has been capitalized by Nika, where they've taken the pain of managing the inventory, but leading to at least a 20 to 30% margin enhancement on their profits. So this again is an extremely good learning to take on how to run a sustainable business model, and how just changing your business model, tweaking a little bit from what's going on in the if say 100 people are following a particular business model and you're going different, and you might have a lot of doubts as to who could be right or wrong. So you must think about how Nika did it right by not following those 100 so-called startups who should have been followed, but Nika took its own path and it said, no, I want to keep control of the quality that gives me about 20-30% extra added profits. Yeah, we can go to the next. Thank you everyone, and any questions, anything that you want to ask, we'll be happy. We want to share our knowledge and the experience that we've had by advising startups. Anything. Yeah.
So one of our attendee wants to know the example of financial indiscipline, which hello.
Yeah.
Am I audible, Anuj?
Yes.
Yeah. So one of our attendee wants to know the example of financial indiscipline.
Okay. See, there are lot of examples. I think I would say that 70% of the failed startups will owe it to financial indiscipline, right? So if you look at Stayzilla for example, right? Stayzilla was extremely well funded. It was funded with $33.5 million, right? And it was on its way to become the largest homestay network in India. But what went wrong? What was the problem there, right? So if you look at it, but see, when people started becoming familiar with online booking, new competitors emerged with better discounts and deals, right? And Stayzilla, because it did not have its math right, the amount of money that they were putting in acquiring one particular customer was way higher than what their transactional profit would be. So say for example, if today your product pricing is 100, and your transaction profit is 50, which is that, to service that particular customer, 50 rupees is what you make from that customer. But to acquire that particular customer, you put in 500 rupees, right? So that's when Stayzilla went wrong, where they ended up acquiring customers and spending too much money on acquiring one particular customer, but the transaction profit from that customer was way, way, way lower, because when the competitors started coming in, they forced Stayzilla to reduce the pricing. Otherwise, they were out of the market. So financial indiscipline, again, had they prepared their financial model well, had they studied the market, and had they forecasted that 3 years down the line, I'll not be able to charge the same amount of money from one particular customer. So should I be spending $100 on acquiring one customer? No, I don't have that luxury. I have to acquire one customer at a $20 uh, pricing. So had they stuck to that, they would have been able to sustain. And most, Ask Me Bazaar, if you look at Ask Me Bazaar, the amount of money that they put into the marketing of the brand, Ask Me Bazaar was pretty famous, right? And people were shocked as to how can a brand like Ask Me Bazaar shut down. One of the reasons was that their financial indiscipline was such that their focus was never on creating profits. Their entire focus was on the next round of funds that they would receive. So there was something that went wrong with the fund house that had funded Ask Me Bazaar. So they stopped funding that particular brand, and they had to shut down because they did not have a sustained business model because of the financial indiscipline. Had they been in a situation where say Urban Ladder has been always, a lot of other brands that have always been, that they tend to not shut down if they don't get funds. A lot of these businesses who shut down because they did not get funding is because they lacked financial discipline. Had they had good amount of financial discipline, they would not have relied on a funding, or they would not have shut down.
So, Anuj, I have one question.
Sure.
Like, can we compare Zomato to Ask Me Bazaar? I think what Ask Me Bazaar did, similarly, Zomato is doing, focusing on the funding part.
Correct.
And similarly, in case of Oyo Rooms, because these guys are focusing on funding part, not on the profit side.
True. So that's what I said, Harshit. So when you look at Zomatos or Oyos of the world and compare it to Ask Me Bazaar, right? Ask Me Bazaar also was on the same path as say Zomato or Oyo, just that its access to capital stopped. And the only competitive advantage that these firms have is the tremendous amount of capital that is there to back them. If you have that kind of a capital backing, then you anyways have a competitive advantage over your competitors.
Mm-hmm.
See, this is what happened, right? With Ask Me Bazaar, had they kept on getting funding, they would have still, ended up being the market leader. So this is what has changed. If you look at earlier businesses like Microsoft always had a competitive advantage from a product perspective. They were always ahead of Apple in launching, though they stole a lot of Apple technology, but they were always ahead in launching, and they were always ahead on the technological and the product front. But that is an extremely tough thing to do on a constant basis, on a yearly, or on a every 3-year basis. So now what has happened is that capital becomes the dictating competitive advantage. That's what we covered. Also, there are two types of models. One is that you have tremendous amount of capital backing you. Then you can look at the fact that I'm still going to have a competitive advantage over all my other competitors because the amount of money that I have. Reliance has that attitude, right? Reliance leverages the amount of money that it has to sustain a business of 5 to 10 years, so that even if they have to incur losses for about 5 to 10 years, they'll be able to sustain it. But the other competitors will not be able to take that amount of loss.
True. So, one more question on Ask Me Bazaar. Someone is asking, just a moment. Why Ask Me Bazaar didn't get funding if they were doing good?
Interesting. So again, this is a very deep question, right? And it's got a very deep strategy to it. So like business has a strategy, fundraising also has a strategy, right? Uh, it's how is it that a few firms are able to carry on till IPO and always keep getting funded till the IPO level, and while there are some firms who are not able to carry up to that level? So what's the reason behind it, right? uh, uh, this is something important that we have to understand, that fundraising is a strategy. uh, if you have enough, if you are investors, so that's what the startup community talks about, smart capital. So you can get capital, but do you have smart capital? And what does smart capital mean? That the kind of people that are putting in money into your business should not just be putting that money, they should also come in with a huge amount of network. And that network will ensure that you get your next amount of funding also. Talking about Ask Me Bazaar specifically, the fund house that had backed Ask Me Bazaar itself got shut down because of some issues that they had. They also had to shut down. Now their next two rounds of funding were planned through that particular fund house only, right? And when that fund house shut down, Ask Me Bazaar was purely dependent on that particular investor. So it's extremely important that your investor is also smart and stable. If your investor is not smart and stable enough to get you an exit in future, your next round of funding is still in doubt.
Okay. So, Arvind sir, can we permit Tushar Tomar? Hello, Arvind sir?
Done.
Okay, so Tushar.
Harshit, Tushar is not there in the as a attendee.
Okay, he messaged
Now
me.
Tushar has joined as a panelist. He's in panel.
So Tushar, can you please unmute yourself?
Yeah.
Yeah, please.
Hello.
Hello. Yeah, Tushar, please ask your question.
My question is like, what should be the must-have features to calculate the transactional profit, which is either equivalent or more than customer acquisition cost? Because there could be multiple more expenses in terms of marketing or branding. So how do we calculate what is the exact number of measures or features that we need to include?
Right. So this was Tushar, right?
Tushar.
Right.
See, Tushar, this purely depends on the nature of business that there is. So while a particular business will not have to incur too much of expense for a repeat customer, but there will be certain businesses that will also have to incur a lot of expense on repeat customers also, right? By sending them discounts, like when we receive so many discount coupons from Zomato or say a lot of other brands, right? What is that? That is their particular cost, which is getting deducted from the transaction profit. So to calculate the transaction profit, it's a very though it requires a lot of understanding of the business, but the fundamental is that every cost that is directly attributable to that revenue should be deducted from it. So say for example, if I'm selling a phone, or say I'm selling a software service, a SaaS based model, my server cost that goes out to service that particular client should be deducted. My cost of acquiring that particular customer because I spent that amount of money. So say for example, I've spent $100,000 on acquiring 1,000 customers. So it's 100,000 divided by 1,000 should be the cost of acquiring one particular customer. That should be deducted from it. And now when you have repeat business from that particular customer, if you spend more money to get him to take more services from you, you need to deduct that retention cost also. So retention cost should primarily not exceed 20% of the customer acquisition cost. So the fundamental is that every cost that you've incurred to acquire that customer, service that particular customer, should be reduced from it. What should not be reduced? For example, the rent that you pay. These are also your costs. The salaries that you pay, the overheads that you have, the marketing spend, which is like the brand building spend that you do, which is not only for acquiring a particular customer, that can be out of it. So yeah.
Okay, so
One more question I have
yeah, sure,
in
sure,
continuation.
please.
So, like recurring customer model includes the retention cost. How do we calculate that?
So retention cost, Tushar, is like I just gave you an example of the discount that you give. So say for example, what does retention mean? Retention means that what are the chances of that customer coming back and giving you business again, right?
Mhm.
So say for example, let's take the example of Zomato. For example, I ordered from Zomato once, and say I ordered a 800 rupees pizza or something. Now I am not going back to Zomato, for example. Now Zomato has the data that this guy is not coming back. Now how do I get him back? So he'll start sending me offers saying that I'll give you a 20% discount if you order again. So that 20% discount that is giving to me, his vendor is not going to give that discount to him, but he's going to reduce that as a cost of getting me back, right? And if there's a third time that he again wants to give me a 15% discount, all of that is the retention cost of getting me back until I get hooked to that particular service or application. So
Uh,
that retention.
okay. So I am running a recurring customer business model, right? So in this, what are the measures that we can consider? Because retention cost herein is, I don't think so there would be any retention cost.
That's superb. That's superb, right? So that not having a retention cost also gives you an advantage to have a higher transaction profit, which means that your profit on a transaction level will keep increasing. Because say for
Hmm.
example, you incurred a particular cost to acquire that particular customer, that cost will only be incurred once, but the amount of revenue minus the direct cost that you incur, the amount of transaction profit will keep going higher and will remain constant after a particular time.
All right, yeah. Thank you so much, Anush.
So we are taking the last question. Arvind sir, can we permit Anubhav Sharma? Yes, he's here. Anubhav, you can ask a question. Hello.
Sir,
I think there's some network issue.
sir, am I audible?
Anubhav, a little
Yes.
louder, please. Yeah, fine. Go ahead.
Okay, sir. So good afternoon, sir. So my question is, suppose if we do well in the market and we have acquired good amount of funding, and next to us a company just copied our business model and they have their funding too, and they just become our perfect competition into the market. Sir, suppose let's take an example of Amazon and Flipkart, Ola, Uber, Swiggy, Zomato, and we both know that we are giving huge discounts to stay in the market in such a way that we both the players are not becoming profitable and are incurring losses. So sir, then what we have to do to kill our competition and become the monopoly in the market?
I think we lost him.
No, he's here, sir. I guess there's some network issue. No problem. So we have one more question. So it is from Sudeep Saxena. He's asking, in your presentation, you have mentioned that Swiggy is not a revenue model. Can you please explain it again?
No, we were trying to mention that they were not non-revenue model or loss-making models.
Okay.
Yeah, so that's why we had put it as an example that a lot of
Okay.
people tend to blame these sort of startups. So we wanted to say this is also one model that we have to
Okay.
accept as a business norm today.
So similarly like Zomato, which we have
Yeah.
discussed earlier.
Yes.
Okay, done. So I guess we have completed all the things here. In case if any of our startup wants to talk to you, can I share your details with them?
Yeah, absolutely. Happy to help.
Okay, sure. So let's wind up the things now. Thank you so much for your time. And I guess it's 13 minutes more you gave us. So thank you so much. Thank you so much for this, Anuj. And we'll be in touch. And we have one, you can say a mentor portal. So I'll share you the link of that. That is mentorworld.org.
Okay.
Okay, so we have 25, 26 startups with us in Noida campus itself. So they can directly connect you there. Vijay sir, you want to add something?
No, Anuj, it was a very brilliant session altogether. You have covered a lot of elements, and a lot of case studies that you covered were completely meaningful for the startups here, right? We look forward for more fruitful sessions from your end. A lot of startups might wanted to work closely with you. Probably we may have to arrange few sessions one-on-one also.
Sure.
Certainly will trouble you out.
No,
Okay.
it's our
Yeah.
passion.
Sure. And whenever you are this side, please visit us. It will be more than great pleasure to meet you.
Same here.
Sure. Thank you so much. Good day. Bye bye.
Thank you. Bye.
Bye bye.